Hey everyone, David and Connor here. We're giving you an update on the USD.AI protocol as we have now launched a governance token. And there's a lot of things that happens behind the numbers that we present through our channels. And this is to better illustrate the roadmap, the plans, the activity, and a lot of the exciting things happening behind the scenes. And to start, we just want to go over like a quick highlight of the main things we'll go over. The milestones, the roadmap, a little bit more about the origination channels that's been developing over the last few months. This is probably the most significant thing that you don't really see on the front end. Additionally, we have started developing the data tracking and understanding the depositor behaviors and users and what we're planning to do to expand this in the near future. Afterwards, a few comments about what we're planning to do in collaboration with the USD.AI Foundation on how CHIP could evolve in collaboration with institutional markets, which we think the design space for token economics can be expanded, but more on that later. First, just a quick few highlights. Of course, you see our numbers on the app with about 400 mil TVL, but with a volume trade of 18 billion. But most importantly, two things that I want to highlight, which we'll go into, is a bit more about the protocol ARR, what's being generated in both origination fees as well as the as net interest margin, which are the two core drivers of revenue for the protocol, which sits at, the protocol ARR is 44.6, but the DAO ARR, which is received by the chip holders, is about 30 mil expected ARR. And additionally, again, with the originations, we have almost 400 mil of inbounds representing $13 billion of origination volume expected, which is a massive increase in the last public announcement we made about this, about the development of our origination channel. But more on this and how it's rapidly growing later in the deck. The key milestones you can kind of go through, but the most important thing is that we are rapidly institutionalizing. NASDAQ listed companies, many of which that we're discussing with, are starting to look at us as as really the only option for them to finance their operations and their growth. Of course, we launched governance token, but across everything around that point here is that we're starting to operate at a very professional level, and our counterparties are getting better and bigger, and bigger. So it's pretty exciting to see what's happening behind the scenes. So we're starting to hire in areas that we need to grow, such as the former core CFO is now a senior advisor. We recently hired an executive director at the DCM desk at JPM, focusing on data centers, as well as head of DeFi, OKX, and Circle to help us expand our deposit operations. In any case, our counterparties are getting better and better, and our growth is in lockstep with that growth. More on the roadmap, of course, the same goals are the same from what we explained earlier in the year, which is $1 billion of loans originated and funds distributed, as well as tightening the processes that we have in the business, such as the underwriting as well as the borrower flows. On the deposit DeFi side, we are kind of pushing the very limits of what's available in DeFi. We had a really successful launch with Fluid and Fluid Lite, where a lot of our deposits are now originated through that channel. But we are also looking with AVEX and Aave, along with other tier 1 curators to help us expand the liquidity for USD.AI, which has been the priority for season 2. We want to expand other distribution channels with SEXs, which will require AMM liquidity, along with other chain expansions, such as with Solana. And of course, where is CHIP going to go? We're again collaborating with the USD.AI Foundation to see what can be improved in this design space. There's a lot of thinking to be done about how value cannot just be bought back and burned, which is the typical standard, but rather commit and compounded. More on this will be detailed in a much longer post, but we think there is ways that, again, our path toward institutionalization, we should be accommodating for these kind of participants, and that's what's planned for CHIP and SCHIP. as more experimental goals, we have the stablecoin as a usage where you're settling compute contracts in USD.AI. This might be more of a season 3, season 4 initiative, but we're already seeing other business models kind of build around the interest rate of the loan book that we are developing. So this is a nice beachhead to kind of expand toward other use cases. We're already doing 3 POCs, 2 successful POCs, where you're able to lower the interest rate while still maintaining the same interest rate for our depositors, but in a much lower risk way by routing the yields. That won't be discussed too much in this. Rather, we will talk more about, of course, the traction, but kind of where the traction has been sourced and why things are growing.
So on the origination side, So just to talk quickly about ARR. So in 2025, the ARR was about 1.1 million. Q2 2026 annualized is about 30 million. I think this is a really important thing to touch on, just, when we think about USD.AI and where the yield ultimately comes from and where the revenues to Chip and the DAO come from, really are 2 places. One is origination fees, and the second is net interest margin on the loans. And so today, as loans continue to get executed and capital from USD.AI continues to deploy and turn from just stablecoin backing into actual productive lending activities, we'll continue to see revenues to the DAO grow. And we're pretty happy to see 30 mil basically run rate in Q2 of 2026. So I'm going to turn over to originations now. I think, obviously we want to make this more visible publicly to the user base, how much is happening behind the scenes on the origination side. So first of all, geographically, one of the big benefits of building things on blockchain rails is not having local jurisdiction limitations per se. So today we've had 100,000 wallets connected, 500,000 users all across the globe, and ultimately active deals across 4 continents, and continue to expand deal presence in Europe, North America, Asia, Australia, and even parts of South America currently. So to talk a little bit about the active loan book, today we have about an average loan size of about $16 million, but as you'll see in a second, the average deal size continues to increase, and we expect typical deals going forward to probably be in the $50 to $200 million range. That's the range where we seem to see the biggest advantage, where USD.AI as an offering is differentiated, because it's still deals that are smaller than bank lending and private credit funds would typically participate in, but it's bigger than what equipment leasing companies would be able to support. And so this has been kind of the sweet spot for USD.AI. If you look down at the weighted average APRs and principals by server type, you'll see that the majority of the exposure is in Blackwells, a little bit in Hoppers, and a very small portion in RTX Pro 6000s and 5090s. I think this makes sense. It generally tracks the distribution channels and the generations of servers as they come out. So today, Blackwells are most common. They're the newest server type, and as a result, most of USD.AI's backing is in Blackwells. As Vera Rubins continue to proliferate, we just saw the first batch of Vera Rubins come to CoreWeave a couple of weeks ago. We just saw our first borrower come to us on a Vera Rubin deal yesterday. We'll start to see Vera Rubins in the mix as well. And this is really the benefit of USD.AI, is having diversification not only horizontally across borrowers and servers, but vertically across generations of exposure. So this is something that users really can't see very well, and we wanted to articulate this in this presentation. This shows you what the top of funnel on the origination side actually looks like. USD.AI gets a tremendous amount of inbound today, which wasn't really the case 6 months ago, because USD.AI has kind of found this niche of offering within kind of this $50 to $200 million deal size. So today we've seen 400 deals, roughly $13 billion in top of funnel value. And this represents, we just checked this the other day, we've had 3,500 emails with borrowers and over 400 hours of calls with borrowers. So this represents, a tremendous amount of basically like raw material, primary data points, not to mention all the information that's shared from borrowers. And all of this can basically be fed into one of the initiatives we're taking on currently, which is agentic underwriting. So taking all of this raw data and turning that into something that can then be used for rapid deployment of capital, something that we talk about all the time and that users, can see is the importance of being able to deploy deals quickly. We'll have another slide on that in a minute. But of that 13 billion of top line, we've had basically 200 million closed, but another roughly 1 billion of deals that are actively basically in discussions to close. And this is kind of where we get to that, target of $1 billion by the end of 2026. That being said, we also have tens of billions of deals that we've passed on because there's just more deals than there is money right now. And so we think the pipeline to be able to deploy, between $5 to $10 billion in the next 24 months is there. And it really comes down to making sure that the capital side is there as well on the USD.AI side.
And to add here, this is something that I don't think any other fund has the diversity of visibility of all these other deals that are happening in the market, because typically, look at a private credit fund, you look at like equipment leasing, or you look at like a bank, they're looking at maybe one or two deals, and that's the only underwriting that they look at. Fortunately for us and the team that's being developed and the process that we're creating, we get to see many, many dozens, and the entire flow and data is kind of being funneled through our chats. So it's just something that's fairly unique and makes us probably top of the world in terms of specialty.
So this is the sales cycle. This is what I was just touching on a minute ago. So we all know that the timeline to get these deals done is slower than especially crypto capital wants. People want to see, loans close and yields come up, as fast as basically deposits can come in. And that's not really the case of reality. But what we have seen is just in this sort of iterative process of improving on the loan offering to borrowers, the V1 deals took on average 121 days to close. The V2 and upcoming deals are taking on average 60 days. So we've already seen this timeline reduced by about half, down to 60 days. And the goal would be to get down to about 45 days. 15 days to get underwriting materials, get a term sheet done, 30 days to execute loan agreements and close deals. And that's basically the goal. And because we now have all of this primary data, not only these calls and meetings with borrowers, but all of the information that comes with underwriting deals and all the information the borrowers have to share, we think that when we start to roll out the agentic underwriting that we're working on internally, we'll be able to rapidly improve the pace of execution and accuracy of execution without expanding costs the way that a traditional lending entity would have to do. So this is kind of our goal, is to get down to 45 days, in the near term for basically loans closed and funded into escrow. We talked about this a minute ago, but I think this is, basically the story of this entire product and protocol, which is that we started in July of 2025 with loans for $500,000. And at that point in time, USD.AI was not a known entity within the lending landscape. And as basically USD.AI has improved its position in the market, it's allowed for the offering to be more prominent in larger deals with more credible counterparties. And ultimately, the best way to deploy capital in an efficient manner is to deploy large amounts of capital. And so we can see this in the growth from $600,000 loan size up to $30 million loan size, up to now $100 million loan size. And we think that for the foreseeable future, we'll be doing deals in this kind of $50 to $200 million range for the most part. And so that will allow us to deploy capital more quickly and ultimately to hit those milestone goals and have, a high yielding product at scale within crypto. So now I'm going to switch over to the deposit side and the DeFi integration side. And this first slide is really just kind of helping to demonstrate what the lay of the land is within the deposit base today. So obviously, the majority of the deposits are smaller and there's a small number of larger deposits. However, if you look at how long the larger deposits hold, they generally are stickier capital, and they make up, if you look down at the top percentage, they make up a lot of the actual total dollars. So even though there's 75,000 unique users, the largest depositors make up the majority of the capital. And so we expect to, as we continue to expand the deposit base, we expect to see this come from more and more frequently from larger capital sources where they're really focusing on the overall yield and credit quality and protections that are baked into the loan book and ultimately the product that USD.AI is. And that's really where we feel like most likely the source of the capital will be coming from primarily. I think this is really interesting. This is, the land and expand beachhead of what the user retention is over time. And you can actually see pretty healthy user retention for USD.AI. Now, most of the holders of USD.AI to date have been points incentivized. And so we haven't had really a strong reason why those users would hold, because USD.AI as a stablecoin has not really been relevant yet. But if we go to the next slide, which is USD.AI, this is where you can really see the organic user base developing and forming within USD.AI holdings. So today we've seen, basically user retention roughly around 50% as far as, almost half a year out. And I think this really demonstrates the benefit of having an actual organic source of yield that's uncorrelated to the rest of crypto markets, because it's showing you that there are users that have come to the protocol. Maybe they were originally coming on the basis of points incentives or otherwise, and now they're finding that the yields are attractive enough that they want to stay in this position. And we think based on the cost of capital for these GPU loans, which is generally around 10%, at tremendous scale, that there is a path for just organic capital to continue to come in because the yield profile is attractive enough to warrant staying in the position relative to whatever else is out there in DeFi. I'll just touch quickly on this. This is mint and redeem activity. And I just wanted to demonstrate on this slide basically the events, the edge events of large redemptions, multiple $100 million redemption days, and the fact that the protocol has been able to service those. And then if I go to the next slide, that over time, we've seen basically a market equilibrium in terms of net capital mints versus burns. So since March, you've seen basically flat mints to burns. And this is really, again, goes back to the organic demand, that we think there is organic demand on the basis of the actual underlying yields being attractive to the market.
Kind of overlaying with those mints and redeems, the USD.AI and USD.AI as yield products it's starting to kind of show a history of being stable, of being reliable, and showing good history of allowing redemptions programmatically, as well as delivering consistent yield. And you see this in really overlaying the mint and redeem flows along with the peg analysis. USD.AI is directly tied to PYUSD in our most recent evolution toward a negotiated deal with PayPal. So it's been mostly stable because it really does represent a one-to-one redemption ability. This will be upgraded pretty soon with a whitelist redeem in collaboration with PYUSDX, where you'll see a pretty interesting mechanism come about that will, again, cater to the user's demands of instant redemption. USD.AI is a lot more interesting because this is the yield-bearing instrument with limited liquidity, but back in February, we had our largest redemption event because this was the end of season 1. So a lot of participants started to look at other yields. A lot of them are coming back, but what you see is a slow progression from our lowest point of quote unquote very slight depeg, still under 1%, but it was rapidly recovered into our redemption windows, which have shown to be very powerful, as you see in the volume days, where we have done over 100 mil of redemptions in a single period. And you actually see now the price kind of will come to an overpeg as we start developing the yield product over time and seasoning it for these different types of counterparties. So it's been an interesting development, and we expect this to continue as we always programmatically allow redemptions, and we continue to deliver yield to our users. And you see here, it becomes a bit of a stepwise function at the very end. That was again related to the evolution toward our PYUSD agreement, where it's more asynchronous in delivery. But again, the yields are higher than what they were at the T-bill rate. But what you see in the APY rather, is that it's starting to stabilize toward a steady state as our utilization is increasing, and as we move away from points as the primary way of generating yield. And as the yield stabilizes, then it becomes easier to use across many DeFi applications and DeFi use cases such as looping and Pendle. And as we develop more and more steady, consistently higher than peers, we believe that more deposits will kind of come about because users want stable and long-dated yield. As the user profile is now shifting in DeFi to our belief toward reliable higher single-digit yields and possibly low double digits. And you see this kind of comparing against comps over time, where the yields are able to deliver, even though we're over 100 mil. Typically, most stables or most yield profiles that are over 100 mil are not able to maintain a competitive yield. But for us, we've always been able to maintain this across the entire life cycle of the product. And it's not high volatility either. You actually see this across different bands, across peers, where they might have higher volatility or lower volatility. For us, because USD.AI earns its yield from uncorrelated yields from a typical crypto volatility asset yields, we're able to keep pretty tight band and deliver consistent results and delivering yield to our end users. This was even more accelerated with our escrow product, where the biggest criticism we had was our loans take too long to deliver the yields for, especially at delivery. We were able to shortcut that with this escrow product, where the borrowers now pay for that escrow period before install, while not having any exposure to the risk. It's just purely a waiting period. So getting more YPO to the users is the goal of the product, and we're hoping to tighten this band even further and maybe raise it even higher as of today, where the yields have now bumped closer to 8%. This is more high-level details of user behaviors. Again, as we rely less on points and emissions and more toward actual yields being delivered and loans being delivered, USD.AI has had a limited reason to grow until we start expanding the stablecoin use case, which I was describing, where you're actually using USD.AI to settle compute contracts. For now, we're really focusing on building up the interest rate and the loan book, of course. And that's kind of been expressed through our DeFi integrations. Fluid has been a great venue and partner in our expansion of socializing the yields across different and more creative ways on DeFi capital markets. We expect to develop that relationship and work with a few of their new interesting offerings, such as liquidity as a service, but also add in more diversified DeFi integrations, such as with Abex and Sky, along with Aave, with our recently approved ARFC, along with other curators that we can collaborate with across different chains, such as in Solana with Camino and Jubilant, and a few others. This is a little more on the point statistics. We just launched a points API for better auditability, but also understanding user behaviors a bit more, unlike the more complex transactions that people are doing. We really want to build the data sets and the tracking to kind of, figure out how users maximize their yields and how they interact with our protocol as we just issued the SUSD and USD.AI. But now we understand a bit more on how they're using it more creatively. But yeah, that's something that worth checking out if you're actively looking at how the points are developing, which will probably be more interesting as we develop more use cases for points that's not just limited DeFi, but that's for a future update. Of course, elephant in the room is that CHIP has launched, and we had a pretty successful launch across many of the exchange listings. The objective, of course, for many day one listings is not necessarily, of course, the volatility of a price, but it's more so being able to have all the distribution venues in the future so that users are able to have access when they want to have exposure to CHIP. And the reason, I mean, we got a lot of pushback to not launch because it's a quote unquote bear market. But what we saw and what the product was starting to see was early PMF. And we wanted to have users to have, users to have access to the governance token at the very early instances of what we're starting to see as a very, very cool product. And yeah, we've had great volume across the various venues with great partners. And this is also a venue for our SEX integration for yield distribution as well for USD.AI in the future. Across Upbit, Coinbase, Robinhood, and Binance, where we're starting to have those negotiations. If you want to take this on the structure map.
Yeah, so I think we wanted to kind of lay out exactly underlying the protocol, the foundation, the legal entities, and how these all work in concert with the on-chain components of USD.AI. Because I don't think this is really ever super clear to users, or maybe it hasn't really been publicly disclosed. So I just wanted to walk through, USD.AI holders are earning yield from USD.AI borrowers, but how off-chain, how do those legal entities connect to the on-chain flows? So there's the USD.AI Foundation, and there's GPU Finance Limited, which is the lender of record that basically is originating loans and then selling the exposure into the protocol. And so USD.AI holders are earning yield from something called participation NFTs, which are deposited into the protocol and represent the net asset value of the underlying loan book. So the fees that are paid to the protocol are then sent to the foundation in the case of origination fees and NIM, and in the case of the underlying yield are sent to USD.AI holders. Now, as we work towards basically setting up governance and all of the things that you would want to see for CHIP and SCHIP, the staked version of CHIP, one thing that is we're super focused on is making a very clear connection between SCHIP and the actual cash flows that are being earned by the protocol as a whole. And we'll have more to share on that side soon as well. But this is something that I think is very top of mind for us. Permian Labs, which is the Delaware C Corp that David and I sit in, is a service provider to the foundation. And so these are basically the entities and the connectivity between a DAO, a foundation, a permissionless protocol, and a development company, and how these all work in concert together. And so what we'll be working on in the near future is trying to simplify some of this structuring and make it a little bit more programmatic, how all these cash flows and on-chain and off-chain components connect to each other.
Yeah. And for us, it is, as Connor said, top of mind and is the actually top priority of the foundation of Permian Labs to kind of develop the utilities of the CHIP utility token and governance token that go beyond the existing design space that we've seen and researched across different counterparties. And this includes Hype, this includes Venice, and a few other peers that we've seen do successfully. CHIP is very different. It's not just it's not an exchange. It represents something pretty powerful, an exposure to AI, of course, but also to a unique product that doesn't exist in traditional finance and doesn't exist anywhere in the world without the powers of blockchain rails. We'll present more about this. We're very excited about what we ideated, and we think it will bring in the institutional counterparties on board that were previously locked out in the previous design that we had, which was just a governance token. But yeah, I mean, this is the first of the series of Lighthouse, which more or less shares the behind the scenes of what's happening behind all the numbers and all the front end and all the development and what we're planning to do in the near future to, well, expand the USD.AI presence all over the world.
Yeah, we continue to think that this is just the very beginning of the story of this protocol, of the product and its success. And we're super excited about what's to come. And we wanted to share more information with users and token holders to be able to visualize some of the things that we see on a day-to-day basis. So thanks for tuning in.